Hi everyone, my name is Yashasvi Tiwari and we will be talking about Chapter 4 Investing in Fixed Income Securities in this video of NISM 21A module. Now in this chapter, we will talk about certain objectives, learning objectives like basic characteristics of fixed income securities, components of fixed income securities, what is the relationship between bond price and yield, what are various yield measures, for example, yield to maturity, coupon yield, current yield, interest rate risk and reinvestment risk and duration of the bond. So let's get started. When there is a discussion with the investors about investments, majority of the investment discussions is around equities. However, the irony is that global value, entire market value of bonds is much larger than the total market value of equity. Not only in size, but number of issues and bonds, they overtake equity. And companies which are issuing bonds, they can issue different bonds at the same time. There might be a different bonds outstanding at the same time. In India, fixed income market is classified basis on who is issuing those fixed income securities. The entities which are actually issuing. These entities are legal entities. For example, if we look at the classification of who is issuing it, looking at the market segment, basically you can look at three parts of it. First part is government securities. So the issuer here is your central government and the state government. Second type of issuer is public sector units. So the market segment is public sector bonds. So government agencies, statutory bodies, public sector undertakings, that is PSUs, will be issuing these fixed income securities. Third segment is private sector bonds. So corporates, banks, financial institutions will be the issuer in this segment. Now, if you look at what is the largest segment in fixed income, it is government securities. GSEC market is the largest segment. What is the next largest segment? Next largest segment is actually the corporate bond market. Is the next largest segment. Now this segment is actually the private placement market, where the private placement happens between the wholesale investors. So there are banks, financial institutions, mutual funds, large corporates, other large investors are the participants in the private placement market. And the share of retail investors in corporate bond market is actually very small. Currently, if we talk about it. Fixed income securities are also regulated by different bodies in India. So the RBI regulates issues which are issued by banks and NBFCs, whereas SEBI regulates non-government securities which are like corporate debt, etc. Let's move into the bond characteristic. Let's understand bond better. So we call bond as a fixed income instrument. So there are fixed financial obligation by the issuer. So that's why we call it fixed income instrument. So the issuer of the bond is actually agreeing to pay a periodic interest, which is also known as coupon, and also it is agreeing to pay the fixed amount of principal at the time of maturity. So that is known as the face value of the bond. So two types of cash flows are expected from the issuer. It can be a principal payment at the end of maturity and the interest payment periodically in between maturity. Now, interest payment, as per the terms and condition of the bond, which is between issuer and the investors, these interest payment can be semi-annually, can be annually, quarterly, and also they can be bonds where there is no interest payment as well. So those type of bonds are also there. We call it zero coupon bonds. Now, based on the tenure or time to maturity, you can define whether the security is money market security or a capital market security. Those bonds whose maturity is up to a year, 1 year or less than a year, they are considered as money market securities. The bonds which are having maturity above 1 year, they are considered as capital market securities. So let's take an example. Let's say there is a bond which is when issued, it had a maturity of 5 years. At that point of time, that bond will be a capital market security. But when this bond It's been 4 years after this bond is issued. So only 1 year is left now, or less than a year is left. So this capital market security now will be called a money market security. So longer maturities can also become money market securities when their residual maturity or left out maturity is less than a year. Let's look at how the cash flows look like graphically. Let's look at it graphically. Now let's say, so we talked about face value or par value of the bond, which is in this case, let's take an example of 1 lakh rupees. There is a bond having a face value of 1 lakh rupees or par value, which will be paid at maturity. There will be a coupon payment or the interest payment. In this case, let's say it is an annual payment. So 8% of 1 lakh rupees, which will be 8,000 rupees annually. So let's say this term to maturity or time frame up to maturity is 10 years. So this is how the cash flow will look like. First year 8,000, second, third, fourth, fifth, sixth, seventh, eighth, ninth. All these year only 8,000 rupees of cash flow. At the end of 10th year, that is on maturity, there will be an interest payment as well as there will be a face value or par value payment of this. So this is how cash flows look like when we look at how issuer pays these cash flows to the investor. So at what price will be the bond trading at? So bond will be trading for these 10 years. So initially at what price it will be trading at? So bond might be trading at the par value, can be trading at higher than the par value. We call it premium to par value, or it might be trading lower than the par value, which is discount. We call it discount to the par value. So when will the bond be trading at these levels? So when the yield or the market interest rate is equal to the coupon. Let's say market interest rate or yield is 8% and coupon here is 8%, it will be trading at 100,000 or 1 lakh rupees. If market interest rate or yield goes up above 8%, that is, let's say 9% or 10% or above 8%, prices of the bond will come down. So in this case, let's say it goes to 9%, this bond will be trading at 92,582, lesser than the par value. If the coupon interest rate goes up, it will be trading, it goes down at, let's say 7% market interest rate, this bond will be trading at a premium. So that's how the bond trades. Now let's calculate, how do we calculate this? Let's understand time value of money. So what does time value of money tells us? Time value of money tells us that money which is today, which we have received today, has higher value than the same amount of money we will receive in a future date. For example, let's say 1 lakh rupees you receive today versus 1 lakh rupees you receive after a year. Which amount will have more value? The money which you receive today. Why? Because you can use that money, put it into a fixed income instrument. Let's say an instrument which is giving 8% return, fixed income, let's assume it is 8%. Then the value of that money will be higher versus money which you will get 8,000 rupees on that 1 lakh rupees, and after a year you have 1 lakh 8,000. However, when you receive 1 lakh rupees after a year, its today's value will be lesser. Its present value, in its value in today's term, which is present value, will be lesser. How do you calculate it? There is a formula to it. That's known as present value is equal to future value divided by 1 plus interest rate, or the rate of discount rate, which we say, or n is the how many number of years. In this case, we are calculating present value of 1 lakh rupees in future. So you put 1 lakh rupees divided by 1 plus 0.08, and you will arrive that 1 lakh rupees value in today's present value, it is 92,592 rupees, which is lower than 1 lakh rupees. So you can, so what does bond, how do we use this time value of money calculation in pricing of the bond? So how we arrive at the pricing of the bond? All the cash flows which are coming in a bond, interest payments which are coming, as well as the final principal amount which is coming on maturity. You calculate the present values of all those cash flows. You add those present value and you come to the price of the bond. Now, at what in interest rate or what market rate, you will discount those all the cash flows in future cash flows. You will discount it at YTM. So what does YTM tells you? Yield to maturity. It is telling you this rate is the amount, the yield which you will get if you hold the bond till maturity. So it is a yield or the rate which you get when you hold the bond till maturity, when you're calculating present value using YTM. Let's take an example. You can calculate YTM, you can calculate price of the bond using TVM calculation. So you can go on Excel and you can do this calculation. Now, when you go on Excel and when you click there for inputting a formula, you can just input equals FV, that is future value. That is a future. If you want to understand time value of money, or otherwise, if you're calculating price of the bond, you can just type equals present value. So function arguments you need to enter in that formula is rate, NPER, PMT, future value, and time. So what are these? Rate is actually the rate of interest, or in this case, bond case, it is YTM, yield to maturity. Okay. Let's take an example. Let's say there is a par value 100 rupees bond and the yield is 7% of that bond. So in this case, 7%. NPER, how many years to maturity? Let's say in this case, it is 10 years. PMT is payment is regular cash flows. How many regular cash flow? What is the amount of regular cash flow which is coming? Not irregular, regular cash flow. Same amount which will be coming on a particular periods. So in this case, coupons are coming on a regularly basis, which is, let's say in this case, 7%. And present value is the price of the bond which you're going to calculate. And there is an option which is type 1 or 0. In bond, there is a simple thumb rule. You will use 0 because the cash flows, what is 0 means? 0 means end of the period. 1 means beginning of the period. When are you getting those cash flows? You're getting those cash flows end of the period. So you will use 0 in the case of bonds. Future value is just single sum which you're getting at a later date on maturity. What are you getting on maturity is the principal amount or the par value. Let's look at, we can calculate price using this example. So 8% is the yield, time to maturity is 10 years. Coupon is 7% of the par value, which is 7 rupees. Par value is 100. How do you calculate present value of the bond or the price of the bond? You just put in equals PV, present value, formula is open. Put a bracket on. You just need to enter all these arguments. Otherwise, you can open this function arguments to understand it better. You can put rate is 8%. Please make sure you're putting percentage mark here. You cannot just put 8. Either put percentage. If you want to put in only numbers, put 0.08 as a decimal. NPER is the number of periods of compounding, or how many, in this case, it is an annual compounding. So how many periods of, when we are looking at coupon, how many periods of coupons are there? So you have 10 times coupon payments in the cash flows. So this is how many periods of compounding? It is 10. If it would be a semi-annual payment bond, then this would have been 20, because we will be getting a regular cash flow 20. Now it is converted into 6 months. So everything will be converted into 6 months. It is rate should be 6 months. This is annual. You have to convert into 6 months. Payment is already 6 months. So that you need to convert accordingly. In this case, it is annual. We need not convert anything. Payment is the coupon. In this case, 7. Future value. Please make sure the money which you're getting, it is in positive sign. So money which I'm getting 7 rupees, it is in positive sign. Future value of 1 lakh rupees, it is in positive sign. Type is 0. Sorry, in this case, it is 100 rupees. So I'll put 100. So how much, what price it will be trading at? So it's trading at 93.29 because it is 8%. Now, if I make it 7%, I'll just make it 7%. I'll change this 7%. It's trading at par value. You can see when the yield is equal to the coupon, it's trading at par. When it is higher, it will be trading at discount. When it is lower, it will be trading at premium. Right? So you can calculate accordingly. So now how will you calculate YTM? Yield to maturity. Let's say you do not have yield in this case. There is a bond which is trading at 107.36. Its par value is 100, coupon is 7%, and time to maturity is 10 years. You want to calculate what is the yield of this bond. So you just put in same formula, just use rate. Okay, bracket open. In this case, N per, you put 10. I'm just directly using cells. Payment is 7, which I'm getting in positive. Present value is negative. Already it's mentioned in negative. You can see here it is negative. Future value is what I'm getting a single cash flow on maturity is 100. And type is 0. So now it has calculated the system. I can calculate anything. I can calculate rate, N per, PMT, face value, future value, and present value accordingly. So you know how to calculate YTM also using this. You can use this to calculate YTM as well. So this is how the inherent calculations of bonds are. So let's understand YTM as we have just seen. If the market price is less than the face value, it means bond is selling at discount, and YTM will be greater than the coupon yield. In the case when market price is higher than the face value, bond will be selling at premium and YTM is lower than the coupon yield. If it is equal, market price and the face value is equal, bond will be trading at par. It means YTM is equal to coupon yield. Right. Let's understand there are certain other bonds which are with options as well. Yeah. So there is an embedded feature there, embedded options there in the bonds. There are two types we'll discuss here. So let's say there is a bond which is having a coupon rate of 7%. It means this bond is giving 7% interest on a periodical basis. There might be a bond, same bond, which has an embedded option of put. What is put option of bond? Put option means that it is a benefit actually to the investor. How it is a benefit to the investor? Put provision, it gives the right to sell the bond back to the issuer at a particular predetermined price on a specific date. So we call it puttable bond. It is beneficial to bondholder. How it will be used? We'll see that. Other type of option is the call option. What is call option of a bond? Call option of a bond gives the advantage to the issuer of the security. Otherwise, you can say callable bond is actually giving higher risk to the investors. So what happens in a callable bond? It gives right to the issuer to redeem all or the part of the outstanding bond before the maturity date. So let's say coupon is 7% and market interest rate goes up. Now, as an investor, you have this bond which is giving you a 7% rate. Market interest rate is higher and you have a puttable bond. So you might feel that the market interest rate is higher. Why should I stick to the same investment where I can go to the market and get higher interest rate? So you can, if the provision says that you have the right to put it back to the issuer on that particular date, you can put it back or you can sell it back to the issuer. You will be benefited. So it is advantageous to an issuer. Otherwise, if it is a callable bond, if market interest rate goes down, now issuer has issued this 7% bond and market interest rate has come down. So in this case, issuer is at risk. Because if it remains here and market interest rate are down, it means the issuer is paying higher interest rate. So if it is a callable bond or if it is a bond with a call option, issuer can call it before maturity and it is beneficial to the issuer. However, it is risk to the investor. So callable bond is beneficial to the issuer, but it has a risk to the investor. What is the risk? So the money which an investor will be getting, there is a reinvestment. Now that money investor has to put it elsewhere, where now the market interest rate has come down. So the reinvestment amount will be lower. So if you compare callable bond with a normal bond, callable bond will have higher reinvestment risk. One more types of bonds are there, which is convertible bond. What are convertible bond? Convertible bonds can be converted into equity shares as per predefined details or terms and conditions given in the indenture of a bond. So let's say there is a par value of 100 rupees bond and there are coupons this bond is giving. So this bond can be converted to equity, number of equity shares. It will be defined in the terms and condition of a bond that how many you can convert it to how many number of equity shares, or you can convert at what rate. So that can be converted to equity shares. That is known as convertible bond. Let's understand safety features of a bond. So what are the various cash flows a bond investor get? You get bond investor gets interest, bond investor get principal payment. If there is a default in those payments, if there is a default in interest or delayed interest or default in principal or delayed principal payment, that is a risk to an investor. That is known as credit risk. Okay, it can be a loss because of either some part of the payment or full payment, or the repayments or payments of interest as well as the principal. Also, there are various types of bonds. So you will see there will be secured bonds and unsecured bond. What is a secured bond? Secured bond is secured or backed by a specific asset. That is a secured bond. Whereas unsecured bond is just a promise to pay those payments of interest and the principal on a timely manner. There is it is not backed by any particular asset of the company. So that is a difference. It defines the quality of a bond. So the secured bonds has a superior quality versus unsecured bonds. So the terms and conditions of the bonds are defined in indenture. It is actually the legal agreement between bond issuer and the bond holders. So terms and conditions are in the clauses of covenant clauses. So what are these clauses? There are two categories of this. There are positive covenants and negative covenants. Positive covenants tells what an issuer can do. Okay, so positive things, so what an issuer can do. Negative things, what an issuer is prohibited to do or cannot do when they are issuing these bonds. For example, let's say positive covenants state that issuer can pay dividends on this particular after issuing this bond. So can pay, or there can be restrictions on dividend payments. So negative covenant might say that the dividend payment will not be above 150% or 80%, or negative covenant might say that the issuer cannot issue any further debt beyond this bond issue. So positive and negative covenants are actually restrictions and the actions that an issuer can do and cannot do, which is actually giving rights to the bondholder and restrictions to the bond issuers. It is required because it is protecting investors' investments. So how to identify what is the credit worthiness of an issuer? So there are credit rating agencies which actually analyze these default risk of various bonds, and they understand the quality of a bond and give ratings to those issuers as well as every single bond. So this is actually inherent part of bond market. You will see credit ratings for all the bonds and issuers who are issuing those bonds. Lot of investors actually they rely on these credit ratings. So these ratings So they are actually determining the degree of the ability and willingness of the issuer, whether they will be able to meet their financial obligation as per the timely manner which is defined in the indenture. So they define the credit worthiness of the issuer. So for example, bonds which are having higher credit risk will have lower credit rating, and vice versa. The bonds which are having lower credit risk will have higher credit rating. So higher the credit rating, lower is the default risk of that bond. Let's look at the rating scale for an example here. So this is a CRISIL rating. So now short-term bonds and long-term bonds also have different types of ratings. So CRISIL will be giving this numeric, alpha rating or alphabetical rating. So CRISIL AAA is actually the highest safety instrument, which is having lowest default risk, versus which is if there is a CRISIL C rating, it is actually a very high risk, and if there is a CRISIL D, it means it is in default. So different types of risk are identified. Default risk basically is identified credit risk, and willingness and whether the issuer is able to fulfill their financial obligation, that is identified here. This is just for an example. Let's understand yield measures. So how will a bond holder identify what is the return this particular bond is giving that person? So there are various ways how an bond holder can look at what are the kind of return. First thing is the coupon payments. So the coupon payment is the cash flow which is coming to the bond holder. Also, this bondholder might have bought at a particular price and will sell at a particular price. So if the bondholder is buying at a lower price and selling at a higher price of a bond, then there will be a capital gain. Otherwise, there will be a capital loss. And the coupons with this bondholder is getting, they can always reinvest that income at a market interest rate. Now, when we calculate yield to maturity, YTM using Excel, you would have seen it is calculated, right? Now, it assumes that the coupon which any investor is getting, they are reinvesting it at the yield, YTM of the bond. That's how the price of the bond was calculated. It assumes that all the coupons are reinvested in the market with the yield percentage. That's for the price. But actually, not all. If it is a very long-term bond, then that will be highly unlikely that all the coupons are reinvested at the same yield which is there, because market interest rate keeps on changing. If market interest rate comes down, investor has this bond, so coupon will be reinvested at a lower rate. So that is reinvestment risk. Various other kinds of yields can be calculated other than yield to maturity. There is coupon yield, is simply how much coupon payment is there on the par value. Let's say there is a bond which has a coupon of rupees 8.24, face value of 100 rupees. It's trading at 103 rupees. What will be the coupon yield? It will be how much coupon to par value, which is 8.24%. Otherwise, a bond might be bought at a different price. So why would a lot of investors will feel, no, I don't want to calculate coupon yield. Let me calculate the current yield. Current yield is calculated total annual coupon rate divided by the current market price of the bond, not at the par value, but at the current market price. In this case, let's say the bond was trading at 103 rupees and coupon was 8.24. So 8.24 divided by market price. So if you convert into percentage, it is 8%. And yield to maturity, you can calculate using Excel. Now, yield to maturity is the discounting factor. It is telling you that if you will hold this bond till maturity at this current market price, this is the kind of returns you can, or yield you can expect from this bond because of this future cash flows. the accrued interest. There are various cases when you sell the bond and there is accrued interest. So there is a day count convention used for calculating accrued interest. In Indian market, bonds are calculated as a calculation of 3360. What does it mean? It means that a monthly, it doesn't takes into account the actual days of the month, but it will just assume in a month there are 30 days and in a year there are 360 days. Based on that, the accrued interest is calculated. However, when we look at money market, it is based on the actual number of days in a month and yearly number of days of 365, like in treasury bills. So as we have seen in previous slides also, that when market interest rate moves, there is a inverse relation to the price of the bonds. It means if the market interest rate will go up, prices comes down. If market interest rate comes down, prices go up. So there is an inverse relationship between interest rate and the price of the bond. Also, if we look at bond market, prices of the bonds are volatile. Now, what is impacting the volatility of a price of a bond? So there are four things which impacts the volatility of a price of a bond with the market interest rate changes. So based on the par value of the bond, coupon rate of the bond, maturity, how many years left to maturity, and the market interest rate, of course. So let's look at coupon rate. So a bond price is actually inversely related to coupon. It means that higher the coupon, lower is the price volatility, and lower the coupon, higher is the price volatility. So in this case, let's say there is a bond which is having no coupons. For example, zero coupon bond. They will have the highest price change with the given market interest rate changes. So that there is an inverse relation between coupon and the price volatility. And bond price volatility is directly related to the time to maturity, term to maturity. It means the higher the term to maturity, higher is the volatility. However, as maturity is too high, then the effects are diminishing. It means for a lower amount of maturity or the lesser number of years left to maturity, volatility will be high, very high. But if if the maturity is too long, then it will not have that much impact which it would have for a low maturity or a lesser number of years maturity coupon. Otherwise, if you also see that bond price movement is also asymmetrical. If there is a 1% interest change or yield change, if yield will go up 1% or yield will come down 1%, how much will the bond prices go up and down? So when the bond prices go up and when they come down, it's asymmetrical. It's not in the equal proportion. Actually, when the bond prices are going up, it means when the yields are coming down and bond prices are going up, they will go up more versus if they, in the same condition, they would have come down. So it is asymmetrical in nature. This we have already discussed that bond prices are inversely related to the interest rates. Let's talk about duration. Now you want to understand how much is the interest rate risk. So higher the term to maturity, actually higher the risk to the movement of interest. So duration actually help you understand what is the interest rate risk, that is modified duration. Now modified duration is calculated by Macaulay duration, in this case MD, Macaulay duration. Macaulay duration tells you that it is calculated in number of years. So it is telling you that how much time will it take for an investor to recover their initial investment in present value terms. So it is weighted present value of all the cash flows of the bond. It is actually lesser than the time period of the maturity. So it tells you that the investor actually receives have the break even before maturity, but not in case of zero coupon bond, because zero coupon bond doesn't have coupons. They have zero coupon have only one interest, only the one principal payment at the time of maturity. So their modified duration will be equal to the maturity. But for all other bonds where there is an interest payment, or whether it is, or rather coupon payments, whether it is semi-annually, annually, the maturity or the Macaulay duration will be lesser than the maturity. Interest rate risk is when the interest rate goes up, market prices fall down, and when interest rate falls, market prices, bond prices goes up. So there is an inverse relation. That is the risk associated with the price because of the interest rate movements. And because of that, there is a reinvestment risk also. If market prices comes below the coupon interest rate, then the reinvestment risk is there on the coupon which a investor is receiving. They eventually have to invest at a lower market prices if the prices comes down. So that's about this chapter. Thank you very much for listening to me. Thank you, everyone.